My name is Andrik Cordero. I'm an investment professional helping you cut through the noise of the finance and business world. Is the housing market in a 2008-2009 scenario? No. So if I go down memory lane, I was working in my previous life in home building in about 2014, 2015, so about 8 years ago. And when I was working in the home building industry, it cost in the Las Vegas market, it cost between $40 to $50 a square foot to build a house. Today, it costs about $100 a square foot. So if you think about a 3,000 square foot house, rather than costing about $150,000, it now costs about $300,000 to build. And that excludes the cost of land. So if it costs so much to build a property, you're not going to sell something that you can't make a profit on, right? Now, there are some things that skew that number. So we get into some of this inflation, right? Well, we know lumber costs went through the roof during the pandemic. In 2022, lumber cost per 1,000 board feet reached levels of over $1,200. Now, in the beginning of 2023, lumber cost sits around $380. Now, home builders might be able to capture some of that pricing back in saying, hey, you know what? We're not going to pay you as much, and the cost of building then comes down. Now, let's keep in mind, though, lumber is only one trade that goes into making a house. There's many different trades. There's roofing, there's stucco, there's electrical, there's plumbing, there's concrete. And some of these things have not gone down. We keep hearing about inflation. Well, inflation, the index used to calculate inflation, about a third of that is made up of housing. So inflation tends to be sticky, and you don't see that tend to reverse, right? If you look at pricing of movie theater tickets today versus the 60s, even though maybe there might be a drop over a year or two, the overall trend is stark, right? You would be able to buy maybe movie tickets for pennies on the dollar, or for pennies, and now, it costs you typically, over $10 to buy movie tickets. Another thing to consider is interest rates. Interest rates is a pressure that actually pushes housing downward right now. So several years ago, people were able to get mortgages as low as 3%, even in the twos. Now the 30-year fixed rate on average is sitting at about 7%. How is this set? Well, the Federal Reserve sets what's called the Fed funds rate. This is a short-term interest rate used between banks to lend to each other. This drives the rest of the interest rate market. The 30-year mortgage rate is not set by the Federal Reserve. However, the mortgage rate has to be higher than the short-term interest rate lending to banks, because otherwise banks are not going to lend out if they can lend their money to the government and get paid more. So as those rates tend to increase, mortgage rates tend to increase. But there is a supply and demand factor that then affects from there on saying, hey, will mortgage rates go to 8% or will they go to 6%? That could be based on supply and demand. And what we have seen, if we look at pre-pandemic levels to today, housing has not only skyrocketed, we have also seen an increase in interest rates, making somebody's mortgage payment, in some cases, double. So while this is definitely not sustainable, and that's why we're seeing this housing pressure and we're seeing a housing decline, that's very possible that could continue to be the trend. But how far we go down, I'm going to say it's pretty cautionary to say and use caution in saying, hey, housing is going to go down to being an 08-09 scenario. Let's wait till then. Now, some risks to consider. A global recession. If a global recession happens, well, yeah, you could definitely have prices really depressed And rather than having, cooling down of prices, you might have the shoe drop off, right? Now, let's remember, at the end of the day, people need somewhere to live, and they need roof, they need shelter. And so that's why there tends to be a floor for certain services. While I do think housing has a lot of potential to keep going down this year because of all the forces pushing it down from this really high peak, do I think we're in a 2008, 2009 scenario with housing? It's unlikely. That said, timing the market is really difficult. And while we might look to the stock market or other economic data as indicators for trying to figure out timing the housing market, what can happen is these things move in different synchros. So we might see the stock market go down and we say, okay, the housing market's going down too. But you have to remember, the stock market is going to react much, much quicker than the housing market. Every day, Monday through Friday, the stock market is live and you have people saying, hey, I'm willing to buy a company for this price. You don't have every single day someone driving by your house saying how much they're willing to offer on that house. So housing prices tend to be slower in updating. And so while we might see the housing market continue to go down, we might see the stock market go up this year, and vice versa in their correlations. They might not be totally correlated. So keep that in mind as you're thinking about housing in the future here.